In this video, I'm going to share with you how to trade Crash 500 index successfully without losing any trade. Alright, now the first step I'm going to do right now is to check how the market condition is. So we're going to check the market condition right now by first going to the previous market chart. Alright, now this is where price is at the moment. Price is currently at the oversold level on the 1 minute time frame. So what we're going to do next is to check the 1 hour time frame, or we could check the 30 minutes time frame. So checking the 30 minutes time frame first. On the 30 minutes time frame, the price currently at this point. So basically the 1 hour time frame should be at the overbought as well. So on the 1 hour time frame, the market is at the overbought and the market is about to buy because we are seeing a sell in price movement. So this market now is going to buy a little bit before it sells again. And if we zoom out right now, we can see that price is at this point right here, at this point. All right, price at this point. So we can see the space that the market has been buying for a particular period of time from here up to this point. So the market will retest for a particular period of time. The market need to retest backwards, okay? Retest backwards to this point, as you can see. But before the market will retest backwards, it will buy and sell, continue to buy and sell, and that buy and sell, the market will sell to this point, then it will buy a little bit, then it will sell again, then buy a little bit, then resell again. But it's still following that trend on that downward trend, meaning the bullish pattern, right? It's following that downward trend, the bullish pattern. So what we're going to do, we have confirmed our entry right here that this position right now is a buy. We're going to buy the market, but we're going to be scalping. We're not going to, we're not going to waste time on the market. We're just going to scalp the market, taking small advantage of price movement, then we exit the market and wait for another good opportunity. So that's the way you can trade this market successfully. Now going back to the 1 hour time frame, as you can see at this point, let's clear off this object right here. Okay, now we're seeing here that the market has bought up to this point, so we're seeing a sell a little bit. Now the spike is going to come into this market before we place another buy. So we're going to put in the RSI just to level our trade. So I'm going to put the RSI at this point, relative strength index, put it on period here, on put this one to 90 at this point, set here to the level of 10. Then for the style, the red, I'm going to put it on 3 pixels. Then this space line here, this one is going to be on this first one right here. And I'm going to click on down. Then the style, I'm going to put it on this first one. The pixel is going to be on 4. Then the color is going to be on blue, but you can use any color of your choice. All right, now we're seeing at this point the red. Remember, I'll use the pixels theory, okay, just as you see here. Then this line is the RSI. Now we'll just level the trade for a overbought and oversold so that we can see the price movement clearly. And here for the description on the levels, you're going to add sell and buy. You put on sell at the level of 90, then at the level of 10 you put on buy, okay? You put on buy so that you can know when price is at this point, okay? If you want to wait until price gets to the level of 10, which is at the oversold level, then you can place a buy. You can place a buy for about 3 or 4 candlesticks, then you exit the market, okay? If you wait on the market, probably like you wait to count like 10 candlesticks for every 30 minutes, you will be in a profit before the end of the day. So if you have a small account and you want to grow that account, you don't want to lose any trade, because when you're trading this crash market, there's going to be some losses on the market, but you're going to count your winnings. So what I mean by a successful trade without loss is that you, at the end of the day, you're going to have a winning trade. Okay, there's going to be a loss, meaning that if you are in the market, the spike is going to come in if you make a little mistake, or if you are slow to close your trade. Okay, you know that when the spike comes in, it comes in within seconds with the blink of an eye. So if you're in a trade and you want to close in your trade, maybe before you close the trade, the spike comes in and it take away a little profit from your trade. So that one is that you are not fast enough to close that trade, and the spike comes into the market and take away those profits. Okay, but if you follow this strategy, you're going to be in a winning trade at the end of your trade. At the end of the trade, you're going to be counting more of your winnings than your losses on that particular trade, right? So this is it. If you wait for about, let's say, about 20 minutes, right? Let's say 20 minutes, you count 5 candlesticks or 10 candlesticks successfully every 20 minutes. Before the end of the day, you will be in a very good amount of profit. Okay, let's say you are using a lot size of about 0.5. all right, you're using a lot size of 0.5, or let's say a lot of 0.2 right here. Let's set 0.2 right here, and you are making about, let's say 10 cents. Okay, 10 cents. You accumulate all the profits together, give you a good figure for profit, right? Now let's say you each candle takes give you 0.10, which is 10 cents, right? Now just calculate that 10 cents, you calculate it times 10. All right, you calculate it times 10, it's going to be $1, right? 10 cents times 10 is going to be $1. So for every 10 candlesticks you take using that lowest amount of lot size, you're going to be making $1 from that particular trade, right? You're going to be making $1 from that particular trade. So we're saying that every 20 minutes you're making $1 from that trade using a very low amount of lot size. So you are risking about, let's say, about 2% or 1% of your capital, right? From your capital. And using that lowest lot size, is a very good risk management technique, right? Very good risk management technique for using that small lot size to trade, so that if the spikes come into the market, your capital won't be too much affected. Okay, because if you increase the lot size, the amount of loss in your trade is going to be big as well. Although your profit is going to be big, but the loss, if the spike comes in and you get caught up with the spike, your loss is going to be big as well. It might even end up blowing up your account. So that's why we're always using a very good risk management technique. So for, let's say, the reason I say every 20 minutes is if you want to wait until the market gets to the overbought before you place your entries, or if you want to wait until the market gets to the oversold before you place your entries. Now you can wait until the market gets to this level of 90 before you place your sell. Okay, that's if you want to catch the spikes, right? And you can wait until the price gets to level of 10 before you place a buy. All right, now if you want to count 10 candlesticks, meaning you're going to be waiting until when price get to a good position before you place that particular buy. So let's say price gets to every good position, all right, a good position in every 20 minutes, and we have for a day, a day, not a particular full day. What I'm saying about a daytime. Okay, I know that people trade in the night, and people, they are day traders and they are night traders. People trade in the day, people trade in the night. So we have about 10 hours a day daytime trade, right? So if you make $1 for every 20 minutes, all right, we have 60 minutes make up to an hour, right? So if you make $1 for every 20 minutes, and 2 times 3, that's going to be 6, meaning 20 minutes times 3 is going to be 60 minutes. That's an hour. So within an hour, you're going to be making about $3 per trade using a very small amount of lot size. Like I said, about 0.2 lot size, right? So you're making $3 for every 1 hour. So 3 times 10, $30 for that day trade, for that trading for that day. You're going to be making $30, right? And you can even use as low as $50 account to make $30 for your day trade. If you want to trade at nine time using that same strategy, it's going to be a good amount of profit as well. That's if you can trade at daytime and trade at night time. So in a particular day, in a full day, which is about 24 hours, you're going to be making about $60 profit for a full day. Okay, so we're just using the day trading time, right? It's going to be $30 profit, like I just calculated, taking just about 10 candle ticks for every 20 minutes. You look for a good opportunity before you place that particular sale. Now, how do you find this good opportunity strategy? So now we're going to put in another indicator that can help us see a good opportunity. So I like using the MACD because the indicator is actually more accurate to me, right? The MACD is one of the best indicators I like using to trade. So if you add the MACD into this trade right now, I'll put the fast EMA 14, the slow on 24, just as you are seeing right now on my screen. This is the setup. So what I'm going to change here is the main. We're using the main on 4 pixels. Color, we're going to put it, leave it on black right here. The signal red, 4 pixels as well. Then click on done. Okay, now this is how I'm going to look for a good opportunity, so that we'll be able to be taking about 10 candlesticks for 20 minutes. For every 20 minutes, taking about 10 candlesticks for every 20 minutes. But you can even minimize that time. You can minimize that time to about 10 minutes using this particular indicator, which I just put in. Now what you're going to do right here is to wait until price gets to this point, level of 90. When do you see that this is this MACD here, these black lines? When they have grown up to this point, then you wait after the spike, because when it's at this point, the spike is going to come in on the market, right? Look at it, trace it downwards. You can see at this point, spike came to the market here. So you always wait until price gets to this point and you wait for the spike. After the spike, you place a what? A buy. When you zoom out right now, we can see this is oversold. So the market cannot continue to sell downwards. Okay? Cannot continue to sell downwards. Although there's going to be some instance whereby the spike come into the market, and after it has gotten about 2 buy candlesticks, then it's sold a little bit again. You don't need to be afraid at that point, even though it's sold a little bit, taking about 3 candle pips away, 3 candlesticks away. You're going to make back that profit, right? Now you wait. Okay, after the spikes, you place a buy, taking about 5 to 10 candlesticks. Now these 10 candlesticks you're going to be taking at this point is not going to be a straight 10 candlesticks. You're going to be taking 5 after 5. What I mean by 5 after 5 is you're going to count 5 candlesticks, then you take that profit. After you have taken that profit, you exit the trade. Then after you have exited that trade, you wait again for another opportunity. Just as you can see, you wait until it counts up to this point, go to this point. Let's say from here to this point, it took about 20 minutes. Then you wait after the spike comes into the market, level of 90. After the spike, you place your buy. All right, now this is the instance where I was talking about that the market could spike after 2 candlesticks. Okay, just as it did here. After 2 candlesticks, the market spiked. You see, it spiked. Right now, if we zoom out here, we can see that the market here is at the oversold here. It spikes up to this point, and at this point right here. So this is when, before you place each entry, you want to check the higher time frame, the 1 hour time frame, to confirm your entries. Don't always depend on the indicators alone. Okay, if you are trading, look at the charts. Know where the price is. If it's in a place where there's higher liquidity, you see the place where say where there is higher liquidity, you know that the market is highly volatile, right? So it's the market always want to, you know, spike. If you buy, the market always want to spike. So that's what you should get at the back of your head, that this market wants to spike all the time. So you need to be extremely careful. So that's why you need to be checking the price, the chart, checking the chart, know where the market price is at the higher time frame. Okay, you can only know at the higher time frame, because once price is at the oversold at the 1 minute time frame, price can be at the overbought on the 1 hour time frame. Okay, so if price is at the oversold on the 1 minute time frame and you place a buy, and price is at the overbought on the higher time frame, and if the spike comes in the market, you're going to be surprised that how the spike come into the market when price is at the oversold, but you forgot that you are trading on the 1 minute time frame, and on the higher time frame price is at the overbought. So go to the 1 hour time frame, to confirm the entries. See here, this is the higher time frame on crash 500 index. The market just sold from here to this point, so we're looking at a buy a little bit. At the beginning of this trade, I told you guys that this market, we will buy, it will sell, it will buy, it will sell, but it's going to follow a pattern going downwards, buying and selling, but it's going to go downwards because the market has been buying for a particular period of time. From this point upwards was a buy. Now it's going to follow downward trends, buying and selling, but the trend line is going to be downwards. Okay, but since we are trading on crash 500 and we're taking a spike, we're scalping this market, you know, taking advantage of those smaller price movements ish from the market. So I hope you understand what I've just said to you guys. Okay, I hope this helps you trade crash 500 index successfully without losing your trade. So what are the key points in this tutorial? One, analyze your charts perfectly before placing your trade. Go to the higher time frame before confirming your entries. See where price is. If price is at the oversold on the 1 minute time frame, price might be at the overbought. If price is at the overbought, do not place a buy on the 1 minute time frame. Okay, do not place a buy until you have confirmed your entries at the higher time frame, so that you don't end up losing your trade. Then plan your lot size, calculate your lot size before placing your entries, so that you know the amount of profit you'll be making at the end of the day. You calculate your lot size, calculate its total, how much you want to be making per hour in that trade. That's the only way you can have a winning trade. You can't just start up your trade and expect to have a winning trade without calculating all these things down. So get yourself a book and a pen, jot down and calculate everything you need to make profit for that day. So I hope this helps. If you found value in this video, do it to like and subscribe to this channel, The Daily Forex, for more awesome trading tips and strategies. I'll see you guys on the next video.